James Sullivan, he's head of Asia ex-Japan equity research at JPMorgan, joins us right now from our studios in Singapore. James, thanks so much for joining us at BloombergQuint. Appreciate you taking the time out. How bad is the situation looking amongst money managers, James? Is the risk of here to stay, or is it difficult to predict?
So I'd make a couple of comments on that question. First, I think it's very important to recognize the starting point, particularly from a market's perspective. If you look at where markets started the week, you had many major global indices at or very close to all-time highs. You had very many bond indices close to all-time lows. The U.S. Treasury 10-year was 5 basis points off an all-time low. You had gold at a 7-year high. You had cyclicals versus defensives at valuation gaps that we haven't seen since the peak of the TMT bubble in the late 1990s. And so the starting point from a market's perspective here is extremely important, because we were looking at very stretched markets. And so the downdraft that we're seeing this week needs to be put in the context of that overall statement. From an economics perspective, I think what we're going to see from here is very clear. We absolutely must see both earnings as well as GDP cuts over the course of the next couple of weeks, and that will likely drag on markets. The interesting thing here, however, from my perspective, is while those cuts occur, we're finally starting to see some of the high-frequency activity metrics out of China start to stabilize. And so if you look at traffic statistics across many major Chinese cities, if you look at shipping statistics and a lot of the custom indices that we run at JPMorgan to try to understand live manufacturing activity on the ground in China, those are actually starting to stabilize. And so earnings will generally lag reality. I think we'll see that in this instance again. The fact that markets entered this conversation at extremely elevated levels is an important part of the conversation. And so as we look forward into the second half, all of that has to be taken into account.
So in light of that, James, since we're considering the fact that while cases in mainland China would have started to drop, the rest of the world is starting to peak now in terms of new cases of coronavirus. Any which ways, the hub of the supply chain, which has been China, most likely will extend beyond this quarter. In light of that, is the market pricing that in, or there's still more downside left to go because we've still not seen the full-blown proportion of this?
So my personal expectation is that you will see markets weak, at least over the course of the next couple of weeks. Again, we will see an acceleration in virus activity in multiple countries around the world as we enter that accelerating phase of the overall development curve that we've seen in markets like China, that we've seen here in Singapore, that we're starting to see in markets like Korea. And that will be a negative drag on overall economic activity. We are also still, as we said, primed to see a lot of earnings and GDP cuts over the course of the next couple of weeks. And so I don't think that the market sell-off is necessarily finished. For investors that are willing to look through that, however, we still are looking at this as a time-defined event. Yes, it will destroy demand in the first half, but as we look forward into the second half, there's two critical conversations that we're having with clients right now. Number one is, what is the degree of economic pickup that we will see naturally as activity starts to reemerge in markets like China? And again, we're already starting to see some early signs of stabilization on those statistics. Second, and very interesting, is the reaction function that we're seeing from both central banks and governments. We at JPMorgan are now penciling in a 25 basis point rate cut from the U.S. Fed in the July announcement. We did not have that in the forecast previously. If you look at budgets that are being issued in markets like Hong Kong this past Wednesday, it's one of the most stimulative budgets and one of the largest budget deficits that Hong Kong has ever seen. And so governments and central banks are really starting to step up to try to stimulate their way out of the short-term weakness that we're seeing. Now, the fascinating aspect of that, from my perspective, again, is that if this is a time-defined event, a lot of the stimulus won't actually hit until the second half. And so one of the second conversations that we need to start having now is, what if we face an overstimulated global economy in the second half of 2020? What implications does that have for activity? What implications does that have for inflation statistics globally?
So, James, just to carry forward to that, you spoke about Hong Kong, and most of the conversations around, the big handout that the Hong Kong government is giving to its citizens is that this money actually may not be put to use by them. It will not go back into the system unless and until there is some meaningful indication that workers are going back onto their jobs. So the point of that being, it'll just lie idle without being put to good use.
I wouldn't disagree with that statement at all. There's a very, very well-established body of academic research that shows a one-time gain given in a period of uncertainty is far more likely to be saved than spent. And that's a very important statement given that roughly 71 billion out of the 120 billion Hong Kong dollars in stimulus that the current budget implies is based on this 10,000 Hong Kong dollar per person giveaway. If all of that goes into savings accounts, then the budget is not nearly as much of a stimulus as it would appear at first glance. And so I would very much agree with that. And again, there's a very, very large and well-established body of academic research to support that thesis.
Yeah, but I think James' point is well taken, because I think if I look at history around SARS as well, the Hong Kong government's announcement of a 1.5 billion relief package probably helped markets then. James, the other point is, while things around China, as per your indicators, are looking like stabilizing, the breadth and the pace of the outbreak in the other areas, some of which might not have the possibility to quarantine things as effectively as China has, and that pull down in economic indicators. More importantly, that pull back of risk on money and the impact that might have on equities. I mean, maybe the impact of the virus is contained, but what if the risk off mood only sullens further? What does that then do to equity valuations, equity levels?
It's a great point. And if I take a step back, very simplistically speaking, there's only two things that can move an equity market. One is earnings. The other is the multiple that is applied to those earnings. We still see an adjustment function remaining. We still see earnings cuts to come. But the point that you're making is extremely relevant, in that the multiples that we are talking about in most major markets around the world are at very elevated levels. And so we do incrementally see the opportunity for multiple contraction as we go through the next couple of weeks, next couple of months. And so you put those two dynamics together, and it's difficult to argue for a resumption of the bull market over the course of the next couple of months. That said, as we then transition into the second half, the potential to see an overstimulated global economy on the back of central bank rate cuts, on the back of very aggressive government stimulus in fiscal policy in multiple countries around the world, is something that we need to better understand as we go through the year.
James, one last question with regards to foreign investors and the kind of fund flow activity that we've been seeing, particularly for the emerging market pack. Now, while India may not directly have large number of coronavirus cases, there's a trickle-down effect of supply chain disruption that will impact companies out here. And while obviously India-centric direct fund investments don't happen, they happen as an allocation to the emerging markets, and then a part of it goes to India. Do you see that getting hampered a bit?
So India, from a bottoms-up fundamental perspective, is not nearly as exposed in a lot of our other large regional markets, particularly China. If you look at the import-export statistics out of India, India actually imports 4 times the value of goods that they export to China. And so it's actually relatively defensive from that perspective. But you're right, if there is a larger risk-off trade, ultimately emerging markets trade, in our belief, off of their growth premium to developed markets. And so if we're starting to question global growth on a short-term perspective, if we're starting to question in particular emerging market growth, then the asset allocation into emerging market funds would likely suffer on that dynamic. Again, for us, this is still a time-constrained conversation. It's still very much first half versus second half, but from a short-term asset allocation perspective, I wouldn't disagree with you.
James, we leave it at that. Thank you so much for joining us this morning. Really appreciate it.